it's hard not to love Florida. You got 1,500 people moving to the state a day. There's tons of neighborhoods and pockets where you can find these centers. So we felt like there's going to be a lot of opportunities for us to look at in Orlando, in Tampa, and along the I-4 corridor.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello, and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Great time of the year, Steven.
End of the year, we're winding down, and in some respects, we're gearing up.
It's budget time. Everybody loves budgeting.
Were you like all those little numbers and staring at those spreadsheets? And I know that's what you enjoy, even though you complain about it.
No, I despise it. Fortunately, we've got a team that helps on the property management side to do that work for us. But still, it takes somebody who's dealing with it, namely me, that's dealing with it every day to make sure that the numbers make sense before we pass it on to our owners. It's a lot of our clientele come to us and ask us to buy properties for them, and then they just want a check. And so we do the check in the mail every month, and so we do all the hands-on work of leasing the plaza and maintaining the landscaping and collecting rent, and then distributing the checks afterwards. But this is the time of year that we engage in the budgeting to look how we did over the last year, and then try to project what it's going to be for the next year, the coming year. And it's a very time-consuming, intricate part of our property management gig. But it's important for investors to know how the previous year is shaping up, or the year that we're currently in, and then also what's the year coming going to look like.
Yeah, it's also, the budget's really a great catch-all. When you're looking at numbers and once something pops out, it's a great safety mechanism.
Yeah, there's no doubt. That is part of our mechanism to make sure that we're getting the returns that our clients want. Wanted to change subjects a little bit here, Stephen. We love reviews, and we've been getting quite a bit of them on the Google Play Store as well as the iTunes Store. Please keep those things coming. It is important for us when we're acquiring guests to have a point of reference that somebody's actually paying attention when a guest comes on the show. So we really appreciate those guys who've gone on and left reviews. We're going to read one from GD off of the Google Play Store. He says, or she, could be a she too, great information and very informative. The insight they give us is priceless. Highly recommend for anyone interested in the Florida market as well as any other market. GD, we really appreciate you going on to the Play Store, the Google Play Store, and giving us that review. Again, that does help us acquire guests. Stephen, we talk a little retail today. We don't talk retail a lot.
Well, retail is an asset class that a few people love and a lot of people are afraid about. So today will be an education process in the podcast of which aspects of retail still look promising for investors.
Absolutely. So anything else before we get rolling into our guest?
Let's roll into the guest. Today we have with us Derek Waltchack. Derek is a partner in Shannon Waltchack, based in Birmingham, Alabama. Derek has extensive experience in commercial real estate. In Birmingham, he spearheaded a $4.5 million renovation that transformed a 100-year-old warehouse into a cutting-edge business center known as Railroad Square. He also did the first crowdsourced development in Birmingham, and that development is known as the Stockyard Birmingham. Currently, he is working on projects in Central Florida. Derek is also a subject matter expert on Bitcoin, blockchain, and how those technologies are impacting the economy in general and commercial real estate specifically. Derek, welcome to the Invest Florida Show.
Thank you. I'm glad to be here.
Hey, Derek, really appreciate the time that you're taking with us today. Let's get a little bit of background about how you and I know each other.
Yeah, so I guess the first time we made acquaintance was through TCN, which is the commercial network worldwide, which is basically an organization that pulls together commercial real estate companies around the world, independent commercial real estate companies. And we have formed a network. I think it's like 15 years old, maybe 20 years old by now. But a network of these offices so that we can act as a larger organization, both in, passing deals around and opportunities, and then also just sharing best practices as business owners. So I got to know Eric through that initially.
Yeah, I mean, we've recently just joined, so we had the opportunity to meet up at the ICSC conference in Orlando in August, I believe. And it was August in August, correct. And we learned a little bit about your investment strategy and that what you're working on too. So we're going to get into that a lot today, but wanted to sort of start from ground zero. You're a broker, you're based out of Birmingham, and then you became an owner. So let's just sort of talk about that transition from why brokerage, and then how did you transition from broker to owner?
Okay. That's a great question. So I hail from Franklin, Tennessee, which is suburban Nashville. I went to college in Birmingham at a school called Samford, and had an internship at a commercial real estate company my last semester. I was actually going to go to law school in the fall of that year, but ended up staying at the real estate firm and working with a gentleman who actually had a terminal disease. He had Lou Gehrig's disease. So I actually worked with him for a year as his health got worse, which really was the way that I actually got in the business. I wouldn't have been able to. They paid me a salary because he had a business going. His name was Ken Sibley. And so I was able to be his assistant and then learn the business and then get paid while doing that, which really enabled me to be in real estate. I would not have been able to, go a year or two without making much money. So very thankful for him and his life and for the company for giving me that opportunity. I quickly, he did apartment transactions. I quickly pivoted and started working on retail transactions. I just had it in my blood. My dad was a executive at Service Merchandise growing up. I don't know if y'all remember that,
cool.
that company or not. But I think I had just retail in my blood from, growing up with him working there. A couple years into my career, I was doing site selection for Regal Cinemas and Taco Bell, Arby's, Big Ten Tire, Express Oil Change, et cetera. And what that did was I learned the state of Alabama because those people had different needs, all over the state. And what I became was an expert in those little bitty markets that we were trying to get into. And so my first ownership deal was an opportunity. I was looking on behalf of Arby's and Waffle House for a site in Madison, Alabama, which is Huntsville. And so they wanted to both be on this corner. And there was this site that was about 2.5 acres, and it was owned by this lady who I think she was a widow. And she did not want to break the site up. So Arby's wanted the corner, but she wasn't willing to subdivide or to do any of that. So she was just saying, hey, if somebody wants to buy the whole thing, they can. And the price that she was asking for the 2.5 acres was really what an acre or an acre and a half would have been worth. So if you bought it, you essentially got an acre for free. So I went to Arby's, who was my client, and I said, guys, I'll take this down and deal with the rest of the property if you'll let me do a build to suit. And they said that they would do that. And then Waffle House basically said the same thing. And we did a ground lease with Waffle House on the back portion. And then we were left over with some property. So that was my very first ownership deal. I was very fortunate to be able to do it. It was I think 3 years into my career, and thought, I probably won't be able to do another one of these in my career, but this will pay for my kids' college. And then, after another year, another opportunity popped up, and fast forward to 2005, I owned probably eight or 10 properties. My partner, Lynn Shannon, who was really my mentor, he owned probably 15. And we said in 2005, really what we did love is the ownership, not so much the brokerage. And so we started our Shannon Waltchack in 2005.
So Shannon Waltchack is the brokerage, and they also owns property, correct?
Yes. So at Shannon Waltchack, we do three things. We buy, sell, and lease and help people do those things. Full service brokerage shop. We've got about 10 full-time brokers. And then we do property management. And then we put investment deals together. And so we own with investors about $250 million worth of shopping centers and office buildings. And then we manage another $100 million worth of assets for other people. So that's in a nutshell who we are.
So what do you do in your spare time?
I have a farm, and we raise chestnut trees, actually.
Really?
Yeah, really.
Oh, that's very cool.
That's probably not germane. So,
all right.
Yeah, I mean, it makes sense. It's all like your nuts. It makes sense. It makes sense, right?
I also have 6 kids, so that probably adds to it.
So you have to squirrel away. You really have to do that.
Oh, he's sharp today, Derek. I'm sorry about that.
No, it's good, Stephen. You are sharp.
So we originally kind of came together. You had been asking about, hey, somebody came onto the TCN network that's from Florida, and you were interested in expanding in Florida. So expanding not from a brokerage standpoint, from an investment standpoint. So why don't you talk a little bit about what you're looking for in Florida and how you arrived at the asset class that you're interested in purchasing?
That's a good question. So I guess 3 years ago as a company, we said, we own a lot of real estate in Alabama and a lot in Birmingham. What can we do that can expand us geographically? Because we've got a lot of eggs in this basket here in the state. And we thought about, okay, well, maybe we should become really good at student housing or senior housing or self-storage or some specialty, that we can become good at that can travel geographically. We kind of looked at that, studied it. I went to a self-storage conference, and honestly, it just none of it really rung true to what we know and what we love. And really what we're good at are small retail properties. That's what we've been able to afford to do, kind of starting, not being independently wealthy, but needing to bring in investors and that sort of thing. So we own when we were making this decision, I think we owned like 30 unacred small retail strips. And we said, that's really what we know well. And so we started studying that market and looking at other markets and kind of how those strip centers functioned. We said, we can actually go and put a fund together to go buy these assets. In the middle of all this, you had the retail apocalypse, or whatever you want to call it, where, a good number of malls got hit, a good number of power centers, grocery anchor centers seemed to be doing okay. And then the small unanchored centers were doing well as well. And we looked at performance of these strip centers when we went through the Great Recession, and we stayed 95% full with these little centers. And we were kind of like, why was that? Why didn't we blow up when a lot of other people seemed to blow up? And I think what happened during the prior 10 years was you had more and more users who wanted these small, easy to access, highly visible strip centers. If you think about it, 10 years ago, you wouldn't see a lot of medical users in these little retail strips.
Right.
But now you've got PTs are blowing up, a lot more medical users. And then if you think about who are the constituents in these little centers, it's services, it's nails, hair, spas, it's things that Amazon can't replace because you're actually doing a function on site, food, nails, hair. And so we also started looking around the country, and we found these pockets of other owners who are trying to put a strategy together to own a lot of these. You have Crow Holdings in Dallas, which owns $650 million worth of these small and anchored strips. And you have a group out of Denver, you have 2 or 3 out of Atlanta. And so we think that these small and anchored retail strips will become an institutional asset class, institutionally owned asset class. Like today, you don't have any REITs that own nothing but these little strips. You have retail REITs that own, kind of a mix. But with the amount of people who are kind of digging in the sandbox, you have site centers, which is the old DDR. They've set up a wing where they now own one of these little deals in Austin, Texas. And as I understand it, they have 5 more under contract now across the United States. And Crow Holdings owns $650 million worth of these. And the trick, I think, is going to be the people who aggregate a number of these centers are going to be players down the road when someone tries to put together a REIT. because they're hard to aggregate. You're spending $3 to $10 million per. And if you want to put $1 billion to work, you have to, it really takes time to do that when you're doing $3 to $10 million at a time.
And it's interesting. We're of the same mentality. We've been saying that the death of retail has been greatly exaggerated for a while, and certain asset classes, sub-asset classes within that retail asset class have certainly suffered. There's no question about that. With the internet-related box anchored centers have been hit really hard. The covered malls have been hit really hard. And you see across the journalistic world talking about retail that it's just the worst asset class on the planet and blah, blah, blah. And for us, we try to preach some sanity in that mentality because the neighborhood center is not going anywhere. You cannot sell nails and hair over Amazon. It's not going to happen. And you've also had a big movement in medical, as you say, from campus centers to try to move closer to where the rooftops are. And so you have this whole medtail evolution that has filled in a lot of the holes of the folks that maybe the card shop that struggled and couldn't really make it anymore. So I mean, we're of the same mindset, Derek. I don't know if there's anything you really want to add to that in terms of popular opinion about retail being just an awful asset class. Obviously, you're investing in it. Maybe you've got something else you want to add.
Well, just to dovetail on what you said, Eric, the ironic part is people used to look at medical office as one of the safest investments, and all these dock-in-the-boxes now have been migrating into these centers, and that asset class has suffered because what's going on in the medical office arena is that the big players are taking big spaces and doctors are now working for them, and all these smaller little dock-in-the-boxes are hard to fill.
Yeah. No, I think that's actually, Stephen, I never thought about that. How the dock-in-the-boxes or the medical office buildings may be in trouble because of the convenience that other little retail strips provide. But I think that's a really good point.
I can tell you from our boots on the ground, because we're out there every day, we see it. And there's spaces like nice medical spaces, and it costs a fortune to build out a medical space, are sitting vacant for a long time.
Yeah, you can't get folks to take it because these docs have all moved into these regional providers, medical service providers, and those medical service providers have made a conscious effort to go from the hospital campus to getting closer to their patients.
Yeah. It's interesting. If you think about, I kind of loop or put retail into 4 food groups: the malls, power centers, grocery anchored, and small and anchored retail strips. Mm-hmm. And if you think about, where you locate a mall, it is at the corner of 2 interstates, preferably. And that is by definition convenient to the most number of people, but it's actually not convenient for any person.
Sure.
It's not near anybody's house, right. Typically.
Correct.
Same with power centers, grocery centers, you start getting closer to neighborhoods. But these little retail centers, they're close to house tops and they have very little friction to get in. Mm-hmm. You can see the tenant from the road, you can see your path to their door, and you park, and 20 or 30 steps, you walk in the front door. So it is harder to get more convenient for people than that. And I think that's why you're seeing these doctors, physical therapists, dentists, orthodontists, that locate in these strip centers that are just easy to see and to interact with.
Well, they've become retailers. They have. And you see it. I mean, there was a time when they didn't advertise, and now they do. They are now retailers. They're advertising their service. So I'm just curious, what made you select out of the 52 states that we have? What made you select Florida?
And also specifically when we talk, Derek, you're talking about the I-4 corridor. So, we want to hear about that too in your explanation.
Sure. Okay. So what we said was we want to, first of all, we've got to develop our core competency to be able to travel and to buy these centers. And so, it starts with, proximity to Alabama. And then, so obviously the Southeast was what made sense and was logical. And then we started looking at cities and growth patterns. It's hard not to love Florida. You got 1,500 people moving to the state a day. And just all that's happening particularly with Orlando and Tampa, and how Orlando is really, it seems to have greatly diversified their economy since the last downturn. You have all the tech moving in. And we just love the growth patterns and how that works. And Orlando is big enough where there's tons of neighborhoods and pockets where you can find these centers. So we felt like, there's going to be a lot of opportunities for us to look at in Orlando, in Tampa, and along the I-4 corridor.
Mm. Yeah, I mean, the growth patterns here, and this is the same. Derek, I know you've done your work independently, and this was long before you and I met, but we hear that conversation with a lot of institutional investors from outside of the state and outside of the area that they're migrating to this area to invest in properties because they are very bullish on what's happening between Orlando and Tampa. And we talk about the I-4 corridor and we had some folks that have been on and they talk about the Central Florida Triangle, which really includes Jacksonville, Orlando to the coast, and then down to Tampa, because when you see what's also happening inside of the villages, the fastest growing area in the country, a retiree, there's a lot of retail and residential rooftops coming out of the ground in there. It's really a very vibrant economy. And it's not just, people think, it's retirees. No, you've got massive transit opportunities also, and that are based out of the Winter Haven area. So there's a lot of things that are happening that have pushed buttons on some of these institutional guys. And whether you want to call it the I-4 corridor or the Central Florida Triangle, whatever it is, it's all sort of happening in that area where all this massive amount of growth and economic activities occurring.
Yeah, and I know I-4 is terrible right now because of the $1 billion they're spending on improving that, but I do really like the long range view that Orlando and I guess Florida in general is able to take on growth where, it's not going to get to a point like Nashville, for instance. That's my home and it's experienced some amazing growth. But traffic is now just horrid up there. Yeah. And they're working on things, but I think Nashville's traffic is going to be much worse than Orlando's traffic will be in, say, 10 years. Because I think Orlando, it seems like they're putting the infrastructure in now to handle the future growth.
Yeah, on top of it, you have to compete with that mouse that lives over there, right?
That's right.
The one with the big black ears? Mm-hmm. Yeah, he causes a lot of the problems over there.
Yeah.
Yeah, it's funny. My wife and I, we were talking last night. We were looking at some old pictures. And we've been to Disney twice with our kids. As I mentioned, we have 6. And so we visited Disney during the downturn. I think it was probably 2008 or 9. And it was easy to walk. I mean, it was great. It was a great time to visit Disney when the economy is really down. And then we visited again, I think it was like 3 or 4 years ago, and it was just a nightmare. It was just so packed. So we need another maybe mild recession to.
Oh gosh, Derek, don't tell us that. We don't want to.
So tell us what actually you are doing now in the Orlando area. What are you developing?
Well, it's not just Orlando, because he actually just bought an asset here in Brandon. You'll know the asset very well.
Oh, whereabouts?
Yes. So let me be really clear about what we're doing. So, I mentioned the firm does 3 things: the brokerage, the property management, and the investments. And so, the investments I would break into 2 sides. One, we have created a fund. We raised a $25 million fund to go after unanchored retail strip centers in growing southeastern markets, and we have bought for that fund 2 properties in Florida. One is in Orlando. It's at the Altamont Springs exit off of I-4. And then the second one is actually in Brandon, which is it's a property that's catty corner to the Brandon Mall. It's anchored by one of the busiest Outbacks in the country. And it's the Outback Strip Center there that's catty corner to the mall.
Oh, right off Brandon Boulevard.
Yeah, right on the main drag. Yeah.
Yes. So we're not developing or redeveloping with that fund. The fund we're buying stabilized properties. We typically we don't want to buy a new strip center that has a lot of TI in it where your rents are artificially above market. We think that's sort of a fool's errand to buy those types of properties. We want to buy a strip center that's 8 to 10 years old. That has some second generation tenants in there where it's gone through a recession and the rents have hit their bottom. They've kind of bottomed out and they're truly at market or even maybe a little bit below market. That's the profile of what we're looking to buy.
we do have a lot of apartment investors and residential folks that are listening to our podcast. When he said TI, that's tenant improvement. That's something y'all don't experience on the apartment, the multifamily side. What'll happen with tenant improvements is there could be any number of reasons in the negotiation that a retailer will ask for the landlord to make an investment in the infrastructure of that property. It could be they need hood and grease trap. It could be the additional electrical phase 3 or phase 4, whatever it might be. The tenant says, in order for me to be able to transact business in this location, I need for X to happen. And that's what Derek's referring to as when he says TI, that's tenant improvement, which is something that our residential folks don't necessarily have to deal with too much. But I'm sorry, Stephen, to interrupt what you going to say, what you're going to ask.
I'm sorry too, but I'm willing to continue. So I was just curious what kind of cap rates you're looking at. I mean, let's face it, multifamily in today's market is like 5, sometimes even 4.
Lower, yeah.
What are you looking at that makes a reasonable investment for you?
Yeah, so the fund structure dictates that, what we're looking for. And so in our fund structure, we pay a 7% preferred return. And then we charge a 2% asset management fee, which is typical on invested capital. And so in order to hit those numbers and then to obviously do better than those numbers, we need to come out yielding around 9.5%. And so with today's interest rates, what that typically means is that we're buying in the 7s, 7 cap all the way down to 7.0 and then, up to 8. It's hard to find that in Florida. It really is. It's, because it's such an attractive place for people to invest, people are willing to take a lower yield. And so typically we've got to find a property that, there's a story with it, or there's something that's a little wrong, perhaps, that the market might see. For instance, the Brandon deal, we had, like I mentioned, the Outback. It's a very successful Outback, but they pay a high portion of their rent in actually percentage rent. So what that means is you have a base rent, and then you have a percentage rent component, which is, in this situation, it's almost, it's at least 1-to-1, if not a little bit more than 1-to-1. And so that sounds great, but if you're going to pay for some of that rent that you're getting, if Outback went out tomorrow, could we release it and get all that percentage rent? You probably couldn't. And so we had to get comfortable with that with Outback. And I won't say any more about that, but that was the reason we actually bought that deal at an 8 cap. And that was the reason. And so we like to find, centers that there's just something a little off that the market can't accept. And maybe because we've done this for so long, we can kind of work with that issue and really box it in and then get comfortable with it.
But, that's an interesting lesson for owners of small centers, or really any asset, isn't it? Because sometimes they make little deals or write the leases in such a way that seems great at the time, but later on it creates a problem for a potential buyer, and they suffer when it comes time to sell. And it may be whether they promise to do a right of first refusal or something down the road, but it seems innocuous at the time, but it can come back to bite them.
Yes, very much so. And it's funny. And I, especially early in a career, you think, in 20 years, that's never going to come, but it does.
Yeah. You used to think 50 was old, right?
Oh my goodness. Of course. I'm 5 years away from that now.
So Derek, tell me about the financing. What's it with, obviously, whether multifamily folks, they know Fannie Mae's sort of the gold star. Are you getting debt from the national banks? Or are you going to the regional community banks, or where's your financing coming from? Your debt financing?
It's a mix. For the fund itself, we're financing these properties either one off or combining a few of them together. And so our options, like today, where could we get money? We could do local banks, and we're typically financing these things at 60 to 65%. And so, we need to be non-recourse. Otherwise we're not going to do it. And so there are some local / regional banks that will do non-recourse if you hit, 60% loan to value or loan to cost. And that works. You can go to life companies. And those are typically good deals as well. The rate may be a little bit better right now with community banks, or the amount of cash that is required may be a little bit better than the life companies as well. And then you always have CMBS, which we're not fans of, but that is where you will get probably the best rate, the highest amount of dollars, and the longest amortization. So if you're willing to put up with all the potential issues with the CMBS lender, those are usually the best deals, but we do that sort of as a last resort.
And CMBS is commercial mortgage-backed security deals. It's securitized debt that's typically issued by banks and then floated into the secondary market. That's
right. And the problem with CMBS typically is that all those loans get pulled together, and then the loans and the just the day-to-day things that happen with loans are handled by special servicers or people who did not originate the loan. And so you're kind of having to deal with someone you don't know who really doesn't have much of an incentive to help you. Like let's say you fall below a certain loan, break a covenant because you lose a tenant or something like that. And it's much easier to deal with a life company or your local bank when those situations happen than with a special servicer, which comes with the CMBS.
Yep. So if someone's trying to, look for a deal, or maybe they want to bring you a deal, can you give us maybe 4 or 5 like bullet points that are important for you to in terms of from your underwriting standpoint that's important to you?
Yeah. And that's a good question. So we would be buying anything from say 8,000 feet up to 50,000 feet, small shops. Unanchored. So if you're thinking about it, if you're a bird and you're looking down at sort of a retail node, we like those strips that are 70 foot deep by whatever wide, 2 to 3 rows of parking, and you've got your major road right there with easy access, highly visible. We want to be at market with our rents or slightly below. It's kind of circling back to what we were talking about a second ago. The reason these new strips are so expensive is A, construction costs is so high now. And then B, when you're doing a new tenant, typically you do provide $10 to $20 in tenant allowance to the tenant to build out their space. And then they're willing to pay more in rent on a per square foot basis. But typically if you see that new center next to the old center, the new center is going to be $10 to $15 more in rent.
Sure.
And, when the vacancy opens up next door and you could move and pay $10 to $15 less, those tenants will do that. And so over time, those centers, market kind of gets established. So we want to buy, like I said, at or below market on the rents. That's, and then in a affluent submarket. So typically we like to see 70,000 average household income in a 1 or a 3 mile ring. And, a dense with some component of daytime population if we can get it.
Now, are you married to the I-4 corridor? If somebody brought you a deal from Naples, you would not be interested, or are you interested all over the state?
No, totally. We got really far on a little strip in Boca,
okay,
which just kills me we didn't get to this day, because it was a deal that brought out a strip center with an office building, and the seller was like, we'll probably have to sell these to 2 different buyers. And so we were in the driver's seat on the strip, and this other group really wanted the strip but wasn't willing to pay the price. So they said, well, we'll take down the office too. And so we lost it. But yeah, so absolutely. We'll go all over Florida. We got really close on a deal in Daytona Beach as well. Someone outbid us for it in Jacksonville, and even like Pensacola. We'll look there as well.
Okay, awesome. So I'd love to learn, and I know it's a really complicated subject, but maybe you can just touch a little bit on all the blockchain and all the new technology that is starting to affect real estate, but most people aren't even aware of what it is or where it's going.
Yeah, shifting gears pretty hard here from talking about the retail stuff, but you know about this alternative payment deals, and so we'd like to hear, because we've not had anybody talk about this on the show before.
Sure. So let's just start really broad and not get too technical with any of this, because blockchain can impact real estate in a lot of different ways, from how you keep your books to ownership, how real estate is actually owned, to even using cryptocurrency as a means of remittance. Let's forget everything else other than just how how ownership can be affected by blockchain. So currently, let's just say the three of us decide we want to buy a shopping center together. Okay. We would, in today's market, we would form an LLC, of which we'd all be members of the LLC, and that LLC would actually own the real estate. And if, say, Stephen decided he wanted to sell out, either we sell that property in totality and, someone else buys it, or Stephen sells his share of the LLC to one of us or to someone else. And there's really not a good secondary market for Stephen in that type of an ownership position. And so there are companies around the United States that are wanting to do what's called tokenizing real estate. And what that means is, instead of you owning a share of an LLC, you would own, let's just create a tokenized ownership for what we just described. Okay. So you have a property, and instead of LLC units, we break it into tokens. And so let's just say there's 100 tokens for the shopping center we just bought. And we own it third. So we each own 33 1/3 tokens, for that property. Those tokens would be traded on a blockchain itself. And so you could create a secondary market for those tokens, where other people can buy the tokens of the actual real estate. And so there's a company right now called Harbor, Harbor. They're based in San Francisco, and they are doing exactly what I've described. They're creating tokenized projects where people can buy tokens. And then what eventually will happen with these tokens is you'll have a actual secondary market where people can buy and sell these things in real time. And so people should look up Harbor and see what they're doing. I think the first tokenized project has already happened. It was I think it was a Ritz-Carlton somewhere, maybe even in Vail or on some mountain, that was tokenized. And so people could buy their share in tokens. And so boil all that down to down the road one day, this is my vision, is you could be at a shopping center with your iPhone, okay? And in the corner of the shopping center is a sign. You scan a QR code, and then that pulls up the shopping center's profit and losses. It pulls up the tenants, basically all the financial information that you want to know about a shopping center just off that QR code. And then from your phone, you could use your Apple Pay, or you could use Bitcoin, or you could use whatever means, and you actually buy a token or 100 tokens or whatever of that shopping center. And then you leave and you actually own that shopping center, a portion of that. And you get monthly or quarterly remittances of cash flow on that property. And then when you're ready to sell, it's kind of the same process. But you open up secondary markets for all these different pieces of real estate that was not doable before, because it's owned in some archaic LLC that has an operating agreement. It's owned by just a few people, and nobody really has much transparency through the property through that, if that makes sense.
So how do you, as just a token holder, have, if you're part of an LLC, you hope that you have a little bit of a dialogue with a management company and some kind of control through that management agreement. So what happens when you're just someone who buys one or two tokens somewhere?
Yeah, well, it depends on what the 1 or 2 tokens would represent. If it represents, 0.5% or 0.1% of a property, you're not going to be able to control very much. But exactly like it would work in an LLC, where it would say majority would rule for major decisions, the exact same thing would apply. And you would have a blockchain where you understand all the tokens are owned by these people. And then if you had to sell the property or put something to a vote, you would do it. And the blockchain would basically record all those transactions and help you decide what you're going to do going forward. That's exactly right. And let's digress for one moment and talk about what you can do with a blockchain. You can create, and we won't go any deeper than this technically, okay? But you can create what's called a smart contract with a blockchain. And so what is a smart contract? Let's think about a vending machine for a moment, okay? So a vending machine is really a couple lines of code that's in the real world. And this is how it works. Let's say you're thirsty, you want a Coke. The vending machine's code says, if you enter 3/4, then I will let you push one of the buttons, and then a Coke or whatever, Mountain Dew or whatever you choose will come out. So if the money goes in, then you get to choose. And then once you push the button, the drink comes out. Okay. So that's pretty simple to understand. But with a blockchain and with a smart contract, you can actually automate that, and you can turn what would be a real world function that would involve people into a contract that is basically automated. Here's an example. Insurance works like this. When you pay money to an insurance agency, and then when the catastrophe happens, you are then paid. Okay. Well, you can actually do that on a blockchain without a person. So there's a company, I forgot the name of the company, but they do this. It's called airline insurance. And so the idea is if your flight is late, then you get paid money. Okay. And so they can do that with a blockchain now. And so what happens is, so let's just say you take half a Bitcoin or a tenth of a Bitcoin, and you buy a contract for your flight to Japan. Okay. And when you land, if it is late, you get paid. And if it's not late, the insurance company keeps your tenth of a Bitcoin. And so the way that works is you pay, you have your Bitcoin and you put it into a smart contract. Okay. That's held by the contract. It's not held by the insurance company. So if the insurance company goes out of business, you don't lose your money in that situation. So the tenth of a Bitcoin is in the blockchain. It's in the smart contract. And then the smart contract has access to public records. And so it can know when a flight was late and when it was on time. And so if the flight was on time, it then sends the tenth of a Bitcoin to the insurance company. If the flight was late, it also has the insurance company's wallet. And so it will send you the 2 Bitcoins or whatever the payout was when it sees that the flight was late. Does that make sense? All right. So that's a smart contract. So you can think, okay, what other kinds of contracts can be written that are automated and that you don't have to trust the counterparty? You see, in that situation, I didn't have to trust the insurance company that they would stay in business or that they would honor the contract. They don't have a choice because the smart contract and the blockchain automates that function. It's an escrow function that is computer code. All right. So marry that with real estate. I mean, there's millions of different ways that you can go with it. And probably that's deep enough for the audience.
Yeah. And this is actually probably would be a great topic for the entire show.
Yeah, I mean, I think it's important actually.
Yeah.
So we'd love to come back on that.
Yeah, let's loop back around and do an entire topic. But it's great that we're connected here through the TCN and whatnot, that we're able to learn about some of these special skills that the agents within the network have. And Derek, obviously an expert in this topic as it relates to real estate, and we definitely want to try to dive into that a little bit more. Folks that want to contact Derek for a deal, they want to involve themselves in his fund, how would they go about reaching you, Derek?
Yes. And we want to see deal flow. We are extremely responsive to brokers. I remember when I was doing straight brokerage, it would frustrate me when I would send opportunities to people and you might not hear anything for a week, or you just get, I don't like it or whatever. We try to really give brokers quick feedback. We protect them if they show us a deal that we haven't seen that somebody else has listed. We'll check and make sure we haven't seen it. If not, then we'll cover you. We'll protect you. But we are very broker friendly because, quite honestly, if we don't have a great relationship with the brokerage community, then we are not going to see the deals that we need to see for us to be successful. Yeah. So we want to treat brokers like we would want them to treat us. And so how do you reach out? My email is dw@shanwalt.com. That's dw@shanwalt.com. They can check out our website, which is shanwalt.com as well. And then I'm on Twitter at dwaltchack, DWALTCHACK. And I tend to tweet a lot about real estate and about blockchain.
Awesome. Stephen, anything else before we let Derek go?
No, I'm just counting these little coins in my pocket and wondering, like how I can make them into little Bitcoins. But, that's a whole other story, that is how to acquire those and do that. But we'll get into that on another podcast. Derek, thank you for everything we discussed today.
Yeah, thank you all for having me. I really appreciate it. And I look forward to hearing the episode.
Perfect. Thank you, Derek.
Bye, guys.
And that was Derek Waltchack from Shannon Waltchack out of Alabama, Birmingham. Stephen, thoughts on Derek?
So I have a lot of thoughts on Derek. I mean, some of the things he said were particularly interested. I like the way, when we have clients, we're brokers and clients come and they want to buy the strip centers and the shiniest, newest strip centers because they got the best looking tenants. And Derek came in and told us that he focuses on just the unanchored but stabilized strips, because when those shiny tenants one day leave, it's hard to replace them at the same rental income. And so they're much safer investments that he goes after. And then, of course, we're going from the horse and buggy into driving cars. And once we start talking about blockchain and derivative markets and secondary markets, and I can see problems right now that we have in the traditional ways of doing real estate, where I have one situation where a minority partner really wants to get out of his partnership and the others don't want to sell their property, and there's really no secondary market. There's certainly place for some other kind of a system that helps everybody out.
Well, it's in terms of this retail center, we have so many folks that will come to us. No, I only want multifamily because, retail is not a good asset class. Industrial, we don't know anything about. Office, we don't know anything about it. But retail, we just know, and it's an education process for a lot of investors when, obviously we can't tell them what level of risk to accept or not accept, but there's a lot of misinformation out there about the retail asset class. Retail asset class is a very stable asset class, despite what you hear. Yes, there have been some problems in covered malls and big boxes, but as long as we're driving cars and there's 45,000, 50,000 cars going in front of your center every day, there's always going to be a need for human beings either buying product or delivering service. And we're not seeing the vacancy rates. Yes, malls have had increase in vacancy rates. Some malls are collapsing. There's a big rework of covered malls around the country. But as Derek says, those aren't the bread and butter outside the strip centers that are outside of rooftop residential developments. Those are the bread and butter. That's not changing. As long as we're driving a car, people are going to want to have that easy ingress and egress to the property, and they're good asset. It's a good asset class to invest in, and so we encourage people to take a look at that asset class and not consider it on the back burner. Put it on the front burner and take a look at it. There's definitely some opportunities there on the retail side. Stephen, Derek was a great guest.
And if you want to hear more great guests, go to our website, www.investfloridashow.com. Also, download the app on your smartphone and listen to the podcasts while you're mobile.
Guys, as always, we appreciate the time that you invest with us each and every episode. Until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida Show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida Show.